All right, and we are live. Hello, everyone, and welcome to Logify's latest webinar. I'm Mikkel Radic, and I'm a content marketing strategist here at Logify. And I want to start out by just giving everybody a big thank you for joining. Looks like we've got people from all over the US and even Canada and Costa Rica. I love seeing where everyone's calling in from. So if you haven't put it in the chat yet, go ahead and put your location there. And yeah, big thank you to everyone for joining. I think with tax day just behind us and the economic uncertainty that we have in the US right now, everyone's eager to learn how to save a little bit of money, right? Doesn't hurt anyone. So very excited to have with me here today Thomas Castelli from Hall CPA to be talking about how to save 5 to 6 figures on your taxes with STRs. So thanks for joining us, Thomas. You want to go ahead and introduce yourself?
Yeah, thank you for having me here today. It's a pleasure to be here. So my name is Thomas Castelli. I'm a partner at Hall CPA. We're a CPA firm that works with real estate investors and business owners across the United States. We help across all different forms of real estate, whether it's single family, multifamily, short-term rentals, multifamily, syndicates and funds, you name it. We've seen it at this point. I personally have a lot of experience with short-term rentals and working with short-term rental investors to help them minimize their taxes. And there's specifically some things you can do with short-term rentals that make them extremely powerful from a tax perspective that you can't necessarily do as easily, at least with other types of rental properties. So I'm excited to talk about that here today.
Amazing. Thank you, Thomas. We're super, super excited to have you. So thanks again for joining. And yeah, Thomas has a great presentation for us today with lots of tips. So I'll turn it over to him in just a couple minutes to get started. But first, a couple of things to keep in mind, just some housekeeping items. We cannot hear you. Everyone in the audience is muted, but we can see the chat. So if you have any comments or questions throughout the webinar, go ahead and put those in the chat. That's on the right side of your screen. Now, if you can't hear us, and I see some people are having audio issues, couple solutions. You might see a blue button on your screen that says tap to unmute sound. If you see that, go ahead and click it. You're muted. Another solution, try turning up your audio. And if that doesn't work, try refreshing the page. A lot of the times that'll do it. And then finally, since we get this question a lot, yes, the webinar recording will be sent out tomorrow. So if you have to hop off early or if you miss anything, don't worry, you'll get the recording via email tomorrow. Now, quick look at the webinar structure so you know what to expect. I'll be starting with a brief introduction to Logify for those of you who aren't aware of us yet. Then I'll turn it over to Thomas to talk about how to save big on your taxes with STRs. And then finally, as I mentioned, we'll end the webinar with a Q&A session. We'll try and get through as many questions as we can in the time we have. So if you've got any questions now or if anything occurs to you throughout the webinar, go ahead and put them in the chat. And then just one request. I know we've all got super specific tax situations that we probably have questions about, but if possible, try and keep your questions as general as possible, just so that the answers benefit everybody here. All right, so what is Logify? I know we've got a lot of Logify customers here with us today, so I'll keep it brief. Logify is a vacation rental management software that helps you manage, automate, and grow your short-term rentals. And our goal is really to help you maximize the potential of your business and take full control of it. And we do that with what's really a comprehensive Logify ecosystem. So it starts with our website builder. If you don't have a website for your business yet, you can use our website builder to create one super quickly, technical skills required. Now, if you already have a website set up, but it doesn't have the potential to accept direct bookings, we also have a booking widget you can add to your existing site to enable that functionality. And then once you have your website up and running, you can use Logify's channel manager to sync your listings and calendars across all of the sites you list on. So that includes your direct booking website, Google Vacation Rentals, and then any third-party booking platforms such as Airbnb, Vrbo, Booking.com, Expedia, etc. Right? And the goal is really to make sure your calendar is synced across all of your sites, so you don't have any errors, any double bookings, any overbookings, and also so that you don't have to go in there and manually update these pages individually, right? We want to save you time. You can also use Logify's unified inbox to respond to guest messages across all of those sites from one place. To help you save time on guest messaging, we also have things like automated guest messaging and an AI assistant, and then also advanced property management tools such as reporting, task management, check-in documents, and a guest app. And then finally, if there's something you want to do with Lodgify, but we don't have the functionality, chances are we connect with a third-party partner who does. We have a marketplace of dozens of third-party apps that we connect with. So you really want to make sure you can do whatever you need for your business in one place. If you haven't tried Lodgify yet, I really encourage you to do so. We have a free 7-day trial you can access using the link there on the screen. There's also a button at the bottom of your screen that says try Lodgify for free. Give that a click and it'll take you right to where you can sign up. And on that note, I will turn it over to you, Thomas, to get into the presentation.
All right. I'm going to go ahead and share the screen and we'll jump right in. Okay.
Awesome.
So as we kind of referenced before, I'm just actually going to move this off of my screen over here. Can you see this? Cool.
Yeah, we can see.
All right. So what we'll be talking about today is something which is known as the short-term rental loophole, and I'll put that in air quotes because I'll get to why it's called that in a second, and how you can use short-term rentals to save up to 5 to 6 figures in taxes. So as this presentation is labeled, this is going to be primarily for U.S.-based taxpayers. I'll address some of the things around that as we go, but just kind of wanted to drop that in there. So what we're going to discuss is why do you even need to use this quote unquote short-term rental loophole, what the requirements are, what material participation is, and how to use it to qualify for this, and how to maximize the tax benefits of this using cost segregation and bonus depreciation. All right, so why do we need to use this quote unquote loophole to begin with? So under the U.S. tax code way back in 1986, the Tax Reform Act of 1986 made all rental activities quote unquote passive, and what that means is that you can only use the rental losses from your rental properties to offset other quote unquote passive income, and not necessarily your income from earned sources like a W-2 or job and other forms of non-passive income like dividends, stocks, bonds, dividends, capital gains from stocks, bonds, etc. And basically, what it was like before that. Right before the Tax Reform Act of 1986, you were able to just buy a rental property and use whatever losses came from it to offset these sources, but really no questions asked. But it became very controversial. People were doing this, and they patched this up with these passive activity rules. So that's kind of how we got here. Then in 1994, the real estate industry ended up lobbying Congress essentially to introduce the real estate professional status, also known as REPS, and this allowed full-time real estate investors to use losses from their long-term rentals and their mid-term rentals to offset their W-2 and business income. The problem is that in order to qualify as a real estate professional, you basically need to be working in real estate full-time, and if you have a W-2 job or another business you're running full-time, means you can't qualify. Now, really, before I go any further here, you might be asking, well, Tom, why do I want to even use losses? Why do I don't want my rental properties to generate losses. I want them to generate income. That's why I'm in this business. Well, there's something called depreciation, and depreciation is a non-cash expense that tracks the deterioration of your properties over time. But that expense can often put you at a loss for tax purposes, despite the fact you might actually be generating positive cash flow. So that's kind of how this all works, and why is this so relevant, why they had to put a patch on this to begin with. But then we enter short-term rentals. Short-term rentals are not quote-unquote rental activities under the U.S. tax code if you operate them in a certain way, which we'll cover here. Instead, they're considered businesses, and businesses are either passive or non-passive, depending on whether or not you materially participate, which is a much lower barrier than the real estate professional status or REPS. So that's what we're going to be focused on here, short-term rentals and how to use these to take the losses from your short-term rentals and use them to offset your W-2 or your other non-passive income to be able to generate substantial tax savings. And we'll also talk about how to increase those losses through bonus depreciation. So the first thing is that in order to move this from the rental bucket, which again is passive unless you can qualify for the real estate professional status, into the business bucket, you must first meet one of the following criteria. You must have an average period customer use of 7 days or less, or 30 days or less if you provide significant personal services that are provided on behalf of you in connection with making the property available to customers. So basically, significant personal services are things that you find in a hotel or a motel, like concierge, daily cleaning, daily meals, things like that, things that go above and beyond merely renting the space to somebody. And at this point, if you're wondering, well, these kind of sound like these rules were for hotels and motels, is because that's what they were written for. Back in the 80s and 90s, running a hotel or motel took significant more time, effort, and operational hurdles to run than simply renting out a property on a long-term basis. And presumably the writers of this law did not foresee Airbnb and VRBO taking off in the way that it did decades later. So that's kind of why people consider this a quote unquote loophole, because you could take a single family property or condo, what have you, place it on Airbnb, place it on VRBO, and or other places, and rent it out for 7 days or less, which is commonly what's used relatively easily, and allowing you to tap into this bucket, right? So that's the first step here. We want to move our rental property from a rental into a business by renting out for an average of 7 days or less, or 30 days or less, and we provide these significant services. So a few things here I do want to clarify on 7 days or less, because inevitably these questions may arise. So in order to determine the average period of customer use, you need to actually rent out the property for the year. Traditionally, with long-term rentals, if you place the property in service, which means making it rent ready and listing it for rent, it's enough to start depreciating the property. However, there's been tax court cases where the tax court has determined that without any periods of customer use, you cannot determine the period of customer use, and therefore you cannot move it into this bucket here we're talking about. So if you do want to use the 7 days or less, or 30 days or less, make sure you do rent out your property at least once. We typically recommend doing it at least twice, so that no one can argue on how to determine the average. So that's the first thing. 7 days or less also means 7.000000, etc., or less. There's tax court cases where they carried out the decimal in this and other use cases out many places. So just note 7 days or less means 7 days or less. If the guest overlaps 2 years, for example, 2024 to 2025, or 2025 to 2026, then that stay is counted for both years. So for example, if someone stayed from let's call it December 25th, Christmas, into say January 2nd, that is what that's however many days that is, and I could count that up, but that stay would count for both years, meaning you'd have that many days in the year 2024 and in 2025. Okay. Another thing, if you have a multi-unit building, say a triplex or quadplex, whatever you might have, the average period customer use is determined by the building, not each unit. So that means if you had unit 1 be a short-term rental, unit 2 be a long-term rental, unit 3 be a long-term rental, unit 4 being a short-term rental, then most likely what's going to happen is the total rental period is going to exceed 7 days or less on that building in most cases, at least that we've ran into. So if you are having a multi-unit building, you typically want to rent it out, the majority of those units, if not all of the units, as a short-term rental in order to meet this requirement. Also, another question we often get is, well, what happens if we do back-to-back leases? Well, that's 7 days or less, right? No. So the way the code is written, the way that they look at this, is that back-to-back leases would give you the effective right of would be 1 period of customer use. If you sign back-to-back 7-day leases, it would encompass all of that, not just that one stay. So that's just a few things on 7 days or less that we want to keep in mind if we are going to do this. Second thing. So once we move it into the business bucket by having an average stay of 7 days or less, or 30 days or less with substantial services, it is now a business. It's not a rental activity. We don't need to work full-time in real estate to get there, but we do need to materially participate. And this would go for any business, not just short-term rentals. So there are 7 material participation tests but really 3 are going to be relevant for most short-term rental investors. And that's going to be that your participation constitutes substantially all of the participation. So what does that mean? You're effectively a one-person show. And that means you're doing all of the work with very, very little to no outside help. The second one, which is by far the most popular one, is your participation is more than 100 hours during the year, and no one other individual participates more time than you do. So that means, for example, you spent 110 hours and no one else spent more than 110 hours. That's the second test. This is the most popular test because it often allows you to use cleaners and repair people to come and work on the property. And as long as they don't spend more time than you, then you can qualify. The third one is you can materially participate for more than 500 hours. Now, this is I'd argue the best one, because you could spend, as long as you spend more than 500 hours, it does not matter how much time anybody else spends. However, I will say, through experience working with many, many, many clients on this, that achieving 500 hours on a single short-term rental can be challenging. So that's why people often opt for that second test. Some pro tips here. If you do want to meet any of these tests, you typically want to self-manage your property, at least in the first year. Why is that? Because if you have a property manager, the IRS automatically considers you to not be materially participating. So you have to overcome that hurdle, which is a significant hurdle to overcome. And B, and that's largely because most of the work that's considered material participation involves property management. So if you do have a property manager, not only does the IRS automatically assume that you're not materially participating, but it's very likely that the property manager is doing much of the work that would be considered material and would be a hurdle for you meeting any one of these tests. Interesting thing here is that both spouses' time, so if you're married, filing a joint return, or just married in general, really, both you and your spouse's time will count as one person. So it's not two different people. That's a cool thing. So, like, for example, if you were married and you and your spouse did all the work, then that would be substantially all if you guys did everything. For the 100 hours or more, your time, your spouse's time are combined for the 100 hours, and you're really looking at no other individual outside of your marriage in that case. Same thing for the 500-hour test. So it's a unique thing that you can do here that's not really possible with the real estate professional status for anybody who has ever considered that, going down that route. Again, the 100-hour test does generally allow you to use cleaners and repair folks to help you manage your property. So that's why it is the most popular test. You can still do a lot of you can still be like the QB and run point on everything and just have people kind of help you out to make sure you can manage your property. Now, something that is critical for any one of these tests is keeping a time log of your time and the time that others spend if you do use the 100-hour test. Because if you do use the 100-hour test, you need to be able to prove that, A, you spent more than 100 hours and that no one else spent more time than you. And if you are using cleaners and repair people, the IRS could ask about the amount of time they spent to verify that they did indeed spend less time than you. So something to keep in mind there. Now, the 100-hour test, one more thing I want to say in there here is this is not a joke, the time log, okay? It's not just something we're telling people to do. I just did a podcast with some of our tax leaders here at the firm yesterday, and we went through case studies. And I think 3 out of the 5 case studies we reviewed involved short-term rentals, and all of them involved the IRS asking for the time log. And what we found is that when you have your time log, it's credible, it's in order, you're not making it up on a whim, the IRS trusts you a lot more and a lot less issues crop up. But when you don't have a time log, or it's not credible because you threw it together last minute, they're likely to ask more questions, and you're just kind of digging a deeper hole. Now, I'm not saying you can't dig yourself out of that hole, but if you have your time log ready to go if and when, God forbid, you are ever audited, you will be able to defend the audit much easier. And by the way, we have successfully defended several clients on this. So this is completely and 100% strategy that works. And we defended multiple audits, but you do need to be able to, they will also ask for the 7 days or less, by the way. So you want to make sure you have 7 days or less. Usually if you're using VRBO or Airbnb, something along those lines, you will be able to print out reports or spreadsheets that you can quickly tally up the average stay, and you're probably going to be fine there. But this is a time log, something you need to keep yourself. There's software and applications out there, that time tracking applications that you can use to help track that time, or you can use a spreadsheet. If regardless of what method you use, you want to have the date of the activity, the property that's associated with, the description of the activity, and the amount of time. So for example, on May 14th, 2025, I went to property 123 Main Street and had to fix the toilet. It took me 2.5 hours to fix the toilet, and that's what I did. That was my material participation. So that log cannot be understated to substantiate the material participation. But once you do that material participation and 7 days or less, or 30 days or less, then your losses from this short-term rental activity will be non-passive. And when it's non-passive, these losses can now offset your W-2 and active business income, which is how we start to generate this substantial savings that I'm talking about here. So real quick, what does material participation look like? I'll breeze through this because I kind of talked about it. Material participation is typically stuff a property manager would do: self-managing bookings, communicating with guests, collecting rents, calling or coordinating with cleaning crews and contractors, or doing that yourself, doing the cleaning and the contract and the repair yourself would also count, obviously. Walking through the property and inspecting on a regular basis, performing repairs or maintenance yourself, things like that. And again, if you are going to be materially participating, you do typically want to avoid a property manager in year one, and we'll get to why year one is important. But this makes losses. So one more thing here I'll put in for partners, just in case anybody asks. If you do have a partner in your short-term rental business besides your spouse, can you materially participate? Yes. But in order for the losses to be non-passive for both partners, you would typically have to spend more than 500 hours each. Because if you look at these other three tests we talked about here, your participation is substantially all of the participation, which means you're doing everything. Right? So if you have a partner, you both can't be doing everything. The 100-hour test, during the year, no other individual spends more time than you. Remember, you and your spouse's hours combined, but not you and your partner's, right? So only one partner can meet this test. So the only way for both partners to have losses that are non-passive or more than one partner to have losses that are non-passive would be to have 500 hours or more for the year, because it does not matter how much time anybody else spends. The challenge with that is on a condo or single family rental, very hard for one person to get 500 hours, let alone two partners. So just something to keep in mind out there. It would be challenging on a larger property or a boutique hotel or something like that. A little bit of a different story, but for most typical properties that you would see, very challenging. So we're actually going to kind of shortcut some of this right now. I'm realizing it's taking a little longer than I thought, but we're going to go ahead and get through it. So personal use. Now, when you're buying a vacation rental, it could be very tempting to use it personally because they are beautiful properties, and who doesn't want to maybe stay at their own property? But the issue is, if you spend more than 14 days at your property, so 15 days or more, then it's considered a residence. And what does that mean? What's considered a residence? It means that the losses on that residence are limited to the income that residence produces. So you cannot create losses. And the name of the game here is we want to create losses so we can use them to offset our W-2 active business income and other forms of income that we may have. So you generally want to stay at your property for 14 days or less. Keep it nice and simple. Note that your family does also count as personal use. So if your family does stay at your property, even if they are paying to stay at your property, that will be considered personal use. Just note that. So the other thing, so the way you could do this is simply avoid using the property personally for 14 days or more than 14 days during the first year. Note that time you spend working on your property for more than 4 hours, which is considered substantially full time, does not count as a personal use day, but you have to be working on the property, repairs, maintenance, things like that. And you have to document that as well. Again, if your family uses it, it will be considered personal use, even if it is fair market rent. Any day someone else spends at your property, say your bestie, right? Your bestie is at your property and they do not pay fair market rent, that is considered personal use. Swap. So if you and I were to swap properties, you stay at my property, I stay at yours, that is considered personal use as well. So you need to have a third party person paying to stay at your property for it to be considered not personal use. So we can take questions on that. Substantial services, I'll breeze through this real quick. What are these substantial services you may see if you do want to use that 30-day test or less? It would be things that you find at a hotel: daily breakfast, daily meals, laundry services, concierge, tours, vouchers, things of that nature. Things that are not considered substantial services are regular repairs and maintenance, cleaning, trash removal, things you would normally find at a rental property. So we're going above and beyond that. So now we're going to get into cost segregation and bonus depreciation. So let me just recap where we are. When we have an average period of 7 days or less, or 30 days or less, and we materially participate, the losses are now non-passive, and we can use them to offset our W-2 income. So how do you maximize your losses? How do you maximize your tax benefits? We do that through cost segregation and bonus depreciation. So we kind of went through what depreciation is. It's a non-cash expense that can often often cause you to report a loss to the IRS for tax purposes, despite the fact that you're actually generating a profit. So the thing is, when you have a residential property, a commercial property, which is typically what short-term rentals are considered, you're going to depreciate them over 39 years. However, there are components within that property. So that means you're spreading this expense out over a very long period of time, and you're going to get a very small depreciation expense each year. Still beneficial, but we want those numbers to be higher. So what you can do is you can do a cost segregation study, which breaks down the components of that property into different class lives, typically 5, 7, and 15 years. Now, by its very nature, these components of the property are depreciated over 5, 7, and 15 years, which is shorter, which means you're getting larger expenses. Now, these expenses are also eligible for what's known as bonus depreciation. Bonus depreciation allows you to rapidly accelerate these expenses in the first year. As we sit here today, under current law, it is 40%. Bonus depreciation is 40%. So you'll be able to deduct 40% of that 5, 7, 15-year property, which is usually, and hopefully I'm not losing anybody with the numbers here, typically 20 to 30% of your property will be allocated to this 5, 7, and 15-year. And I can give a little example of that. But you'll be able to depreciate that 40% of that in the first year. The remaining 60% would be depreciated over 5 years or 7 or 15 years. So that's how it works. However, the new tax bill, the draft was just released, I think 2 days ago now, and they want to bring 100% bonus depreciation back for 2025, which means 100% of this amount would be depreciated in the first year, which can be powerful. To give you a quick example of what this would look like, let's take a property that's $500,000. Okay. Now, it's important to note that land is never depreciated. Unfortunately, you can't see my Can you see my calculator here? Let's see. Fortunately, nope, you can't see it.
Just your slides.
Yeah. So that's the problem with the Windows calculator. So I just have to verbally read this off. Okay. So if we take a property that's $500,000, the first thing we're going to have to do is remove the land value, because land is never depreciated. Now, land value is determined either by independent third-party appraisal or by using the property tax card with your local county assessor, and it'll be able to help you find out what that land value is. But we're going to do back in the napkin math here, and we're going to say that 80% of the property is going to be the building and its components, and that 20% is going to be the land. So we're looking at $400,000 as the property value that would be depreciated. Now, over 39 years, this would be depreciated. You get roughly $10,250 per year. But with the cost segregation, let's say 25% will cut the 20 to 30% down the middle, can be reallocated as 5, 7, 15-year property. You're looking at $100,000. Now, if bonus depreciation is 40%, you're getting a $40,000 reduction in the first year. And at the 37% federal tax bracket, that's $14,800 in savings. Now, if they do bring 100% bonus depreciation back, that entire $100,000 will be depreciated in the first year. At 37% tax rate, you're looking at $37,000. At 24% tax rate, it's $24,000 in tax savings. But that's kind of the power of how we get here. Now, that's 5 figures in tax savings. If you buy like $1 million property or $2 million property, which we have seen people do, you can get into that 6-figure tax savings range, especially with 100% bonus depreciation, which by all accounts appears likely to return in 2025, assuming they can get a bill across the finish line, which, knock on wood, we all hope they do. So that is how we turn up the jets. Now, in this slide, I kind of just went through where we're at in 2025. We're at 40%. Will 100% make a comeback? As of 2 days ago, it seems very likely that it will. So that's how we jack up the prices. I kind of just went through an example here, but that's what it looks like. So to summarize this strategy, rental activities are passive by default, which means we typically can't use the losses that are largely generated by depreciation or non-cash paper losses. We cannot use those to offset our earned income from a job or a business unless we qualify as a real estate professional, which is challenging to do unless you work full-time in real estate. But if your short-term rental, it will be considered a business if it has an average period of 7 days or less. I'm saying this ad nauseum at this point, or 30 days or less, and you provide those substantial services. And then if you materially participate by meeting one of the tests that we mentioned, then your losses will be non-passive. It can offset your W-2 and business income. And from there, we use cost segregation study and bonus depreciation, and we can generate significant losses in that first year of operations, which is why it's important that we have this average stay and we do materially participate in that first year, because that's when this all takes place, and we can generate significant losses. And then after capturing the tax benefits in the first year, in the second year, you could use a property manager. You can make it passive. You can let your friends rent it. You can use it more than 14 days per year. And if the losses are non-passive, are passive at that point, or you can't take the losses because it's a residence, then that's all well and good. Because in the first year, when all of this took place, when it was the most important year, you did the right things and you were able to capture those tax benefits. So that is the strategy in a nutshell. More than happy to take questions at this point. I think I went through a lot. If you do want more information on how this works and how we can help you implement this strategy, you can follow this link, go.therealestatecpa.com/Lodgify, or scan this code, or shoot me an email at thomas.castelli@hallcpallc.com. And that's it. That's the presentation today.
Awesome. Thank you, Thomas. So much information, so many good tips. And I'm glad we have a good amount of time for the Q&A because we have a lot of questions in the chat. Are you ready?
I'm ready to go.
Okay. Let's see. Some of these I hope will be pretty quick, so hopefully we can get through a bunch. So someone says, we have a mix of short-term rentals that they rent out for 7 days or less and long-term rentals. The question is, can we count those STR hours towards 750 REPs?
Okay, so this is a question about, like, can you qualify for the real estate professional status with short-term rentals? So let me break this down for everybody who's listening, and I'll answer the question. So the real estate professional status is mainly going to be useful for people who have long-term and mid-term rentals, because that's kind of where it falls. That's where where it's going to help you. So if you have short-term rentals, the first thing you'd want to ask is, on my short-term rentals, can I just meet the requirements we discussed today? And then the losses on your short-term rentals are non-passive, and you don't need reps, and reps is irrelevant. Now, to qualify for reps, you need to have 750 hours and more than half your total working time in a real property trade or business. That's how you qualify for reps. So if, for example, you do want reps and maybe you do want to make the losses non-passive on this long-term rental, the short answer to your question is your short-term rental hours will count as a real property trade or business. So, for example, if you spent total 500 hours, just keep things simple here, on your short-term rentals, your mix of short-term rentals, those 500 hours would go for that 750 hours. And then you need to spend 250 hours, presumably managing your long-term rental. And if you meet one of those tests while you're doing that on your long-term rental, then you'll be able to take you'll qualify for reps, 750 hours or more, and you'll be able to take the losses from your long-term rental. It's a mouthful right there. Usually we use entity diagrams or charts to kind of explain how that works. But long story short, your short-term rental hours can count towards the real estate professional status.
Okay, good to know. Okay, Nicholas wants to know, what if my other income is 100% 1099 and not W-2, and the majority of time invested is with short-term rental management? Would that qualify?
So 1099 income is basically business income as an independent contractor. So that's typically, that is non-passive. Not typically, it is non-passive. And if you met the requirements that we talked about, the average stay requirements, 7 days or less or 30 days or less, and you materially participated, that would work. So,
all right.
Does 100 hours apply to a total to a couple, or does it need to be 100 hours for an individual? A great question. When you are a couple, you're married, okay, to be clear, then those hours are combined.
Okay. What about if you're married, but you file separately? Is it the same deal?
Yeah. So that's a great question. I'm about 99% certain, if my memory serves me correctly, that even if you're married filing separately, those hours still count. Now, when you're manually filing separately, who reports the income on their tax return? That's a question that you'd have to sort through the deed and all this other stuff. But long story short, if my memory serves me correctly, even if you're married filing separately, both spouses' time still do count.
Okay. And is it per STR or in total of their portfolio?
Yeah, it's a great question. So you can make a grouping election to treat multiple activities as one for the purposes of material participation. So you can group all of your short-term rentals together. It is possible to do that and meet it across the portfolio. Just note that you do need to track the time of everybody who works on each property within that portfolio besides you. Now, one more thing I'll add in about grouping, and I did have a slide in here that I purposely skipped over, but for this, in order to group, you need to meet there's 5 criteria that the IRS considers, 5 of them. And it's the similarities between the businesses. So short-term rentals, most likely going to be considered similar businesses. So you're going to check that box. The extent of common ownership, the extent of common control, geographic location, and interdependencies between the businesses. Usually most short-term rentals aren't interdependent, like say a manufacturing and distribution facility would be. So you're going to cross that one out. So that leaves you with 4 criteria. Not all 5 of these have to be met, but the more that you do meet, the better. So just keep that in mind when you are considering making a grouping election.
Okay, good to know. Another question about the 100 hours. Lots of questions about this rule. Can the time traveling back and forth to the rental be included in the 100 hours?
That's another great question. So the IRS generally considers travel time not to be considered material. However, there is one tax court case, or at least one, where travel time was considered material participation, and the circumstances of that time, and I'll get to my answer at the end of this, but the circumstances of that time was for the real estate professional status, and the taxpayer managed all of their properties locally. They were all within driving distance. Let's call it 30 minutes or so. I don't know the exact timing, but within driving distance. And the tax court and this person had just fell shy of the 750 hours in this particular tax court case. And the tax court judge said, you know what, how much time did you spend traveling to these properties? The taxpayer submitted their time for the traveling, and the the tax court said, you know what, we're going to allow this time and you're going to get to 750 hours. Now, that was one case, and I'll note that they determined that the travel time was material to the management of these properties, so they needed to travel to these properties. B, it was local. And C, it was very clear for the rest of the entire case in aggregate that they otherwise met this requirement but just fell short. So what I would say is you want to track your travel time, but you don't want to use it as a crutch. And if a majority of your time is going to be traveling to your properties, that may be something that you have to battle with the IRS if you are ever audited. And if you are, and I'll say that, so that's local property management time that you're spending. Now, if you have to hop on a plane to travel to your property, that's almost certainly not going to count. So if it's local, you have a case to be made. If it's more than local and you need to hop on a plane or train for a really long time, most likely not going to count.
Okay, so track it just in case, but don't count on it, kind of deal.
Yeah, I wouldn't bet. I wouldn't bet on it.
Okay, so good to know. Now we've got some questions about the 7-day rule. For example, Nia says, is it all or nothing for the 7-day tax loophole, or can you file for the time that the unit was rented under the required 7 days?
No. So it's an annual test, and if it's either 7 days or less for the year, or not, unfortunately.
Okay. Does the tax loophole work for condo units and investor rents out? Thomas mentioned the 7 days or less needs to be on the building and not just a single unit. But what if someone only owns or rents out a single unit?
Yeah, that's a great question. So if you only own or rent out that single unit, that would be fine. To drill down, because you own that unit in that specific space. To give more clarity on that, I'm saying if you own like a multi-unit building, you own the entire thing, and you're renting out different units for different periods of time. That's when it becomes an issue. But in this specific case, or in the cases of condos, that's all you own. You only own that one unit, so that's what we're looking at.
Okay. Now, Michelle wants to know, what if your rental is seasonal and sits empty half the year?
That would be fine as long as the periods where it was rented were at an average of 7 days or less, or 30 days or less with substantial services.
Okay. Now, Andrew is wondering, does the time log need to be maintained every year or just the year you seek a non-rental designation?
Just the year you seek non-resident rental designation for the most part. Having said that, there could be an asterisk on that, a fringe case where the IRS tries to say, okay, well, it was non-passive this year. Why is it passive this year? I've never seen that yet. We've not seen that. Probably unlikely to happen, but you never know. But to answer your question, 9 out of 10 times, maybe more than that, you're not going to, it's going to be only the year that it's non-rental.
Okay, good. So they don't need to worry about maintaining a meticulous log like forever.
Right. I've never seen that. No one I know have ever seen the IRS argue the other way in a case like this. So not saying it can't happen, but right now my answer is no. You don't have to worry about it.
Okay, what if we, a couple, self-manage the rental through or under an LLC we created?
That's fine. That's fine.
That's fine. Okay.
Yeah, that's common.
Um,
Sorry.
no, go for it.
What constitutes a real estate person? Also, does that mean you have to work in real estate in the same stage as your short-term rental? So let me talk about the state part first because it's easier. No, one of the audits we recently defended, the person owned the short-term rentals in many states over. So you don't need to it does not need to be the same state. So what constitutes as a real estate person, or I guess a real estate professional? Real estate professional is someone who works in a real property trade or business for more than 750 hours and more than half their total working time. There are 11 real property trades or businesses. To put that just in regular terms rather than the technical terms, basically you're a real estate agent, broker, or you're a developer, you're in construction, you're a property manager, you own rental properties, or you're a property manager, if I didn't already say that. That's pretty much what you're a fix and flipper or a wholesaler. That's pretty much what real estate professionals are. Okay. In a nutshell.
Does time spent with vendors on quotes or fixes count towards the 100-hour rule, I'm guessing?
Yeah, pretty much. It would, as long as you're managing the property, yes.
Okay. I think I know the answer to this one, but I'll put it anyway. Our rentals at the beach, and most rentals in the area look for snowbirds to book 30-day stays during the winter months. Is this not allowed with the 7-day or less requirement?
Yeah, so you'd have to maintain an average period customer use of 7 days or less for the year. If you do have a stay where someone stays 30 days, for example, like I live in Miami, so I know a lot about snowbirding people down here. You would most likely, it would be very challenging to maintain that average stay of 7 days or less if they were renting out for more than 30 days or 30-day stays and you weren't providing substantial services. Because if you add a 30-day stay in there, even if every other stay you have was 7 days or less, that's going to bump that average up. So it can happen, but it makes it significantly more challenging. You just have to make sure that on average for the entire year, that's 7 days or less. And I'll tell you right now from calculations I've seen, adding 1 30-day stay kind of makes it a little bit more challenging to maintain that.
Okay, good to know. Are the limits on staying at your place the same for a real estate professional?
Yep. So that's the same for any rental property that you have, regardless of real estate professional, short-term rental, or what have you. If you use it more than 14 days, then it will be considered a residence. The losses will be capped at the income that the property generates. So regardless of real estate professional, short-term rentals, or whatever, that is true.
Okay. If you have light food out, like breakfast bars, yogurt, basic fruit, does that count as a substantial service?
Yeah, I mean, I'm gonna probably say no for that. There's been debates about that, but I don't think that like if say for example you rent out a unit and there's bananas there or there's stuff or utensils and things like that. I don't think that would rise to the level of substantial services. Now, if that's refreshed daily by somebody, I think now at that point you are getting into a territory where could be considered substantial services. The way the IRS wrote the code or the regulations is they take the frequency and the totality of the level of services. So they wrote it to be kind of subjective, to be honest. But I would say if you just have breakfast, bars, and yogurts and basic fruit at the unit for them while they're staying there, probably not considered substantial.
Okay, a little bit of a stretch then.
Yeah.
Can you try this if you're in year 4 of your short-term rental versus year 1?
Yes, it is. It could. You could do it. The way that this would happen is presumably you probably did not run a cost segregation study on your property yet. You did not claim bonus depreciation. So what you would do is you do a retroactive cost segregation study and use some fancy tax forms, which your tax preparer can help you with, to take the depreciation you should have taken in that first year and move it into the year in question here, in this case, year 4. Whether or not that makes sense to do for your specific circumstances is something you'd have to speak to a tax professional about. But to answer the question, it can be done.
Okay. And what if they did do this study and they didn't meet material participation in the first year?
Then what most likely happened is they took the bonus depreciation already in that first year as passive. And once those losses are passive, they can only offset other passive income, or they will be suspended and carried forward. And once they're suspended and carried forward as passive, they will remain passive basically until you sell the property. If you were to meet these requirements in that 4th year, the losses that were previously suspended would remain passive and previously suspended.
Okay. I think there's another similar question. Can expenses incurred up to this point be carried forward and claimed as a loss eventually?
Yes. So if, for example, incurred up until this point, if you made it a passive property, yes. But if all the expenses occurred in the year it was non-passive, it would be non-passive in that year.
Okay. If we allow events at our property, that shouldn't automatically put us in the category of substantial services as long as we're still just renting the property out. As long as we're still just renting the property out and we're not managing the events or anything, correct? Very specific.
That's a great question. I'd have to look at the code again, the regulations, to give you a very specific answer, because the regulations say that for substantial services, it's provided for the guest on behalf of the owner, right? I guess you're not, unless you're organizing this. If you're just, I guess what I'm trying to say,
they're not managing the event; they're just providing the location.
Yeah. I guess if you rent out to the person and they decide to coordinate their own wedding at the event with a third party that you're not involved in, I would say probably it's not considered substantial services because you're not the one providing it. That's going to be my answer. I'm pretty safe with that right now with that answer. But if you're the one coordinating the wedding, no, that's going to be considered substantial.
Okay. Let me see if there's any questions I overlooked. Here's one. Is this more for owners or does this work for property managers? I'm actually cleaning rental now and only listening. I'll watch when it comes out tomorrow.
This would be for owners of the property. Yeah, I mean, you might be able to use those hours as a property manager towards the real estate professional status for properties that you maybe own yourself. But this is for the owners. The owners would use this.
Okay. We'll take just a few more. Can you use a Schedule E in some years and then a Schedule C in years where you did provide substantial services?
Yeah, I mean, long story short, yes.
Okay. And we've gotten this a couple times. If I live in the ADU attached to the rental, does that make it a residence?
Yeah, so there's a special carve out for in the code that says if you use a portion of your home exclusively as a short-term rental, that it's not considered part of your residence. So bottom line is if you were to use the ADU exclusively as a short-term rental, that part you could use it on.
Can you use this strategy for a short-term rental located outside of the country?
Yeah, that's a great question. So you could make the losses non-passive. However, when you own a foreign property and you're a U.S. citizen, you have to use the ADS depreciation system, which does not allow for bonus depreciation. So in theory, you could create a loss on the property, but it's not going to be these big substantial losses that you could get with a U.S. owned property when you use cost segregation and bonus depreciation. It's just not going to be you're not going to be able to use the bonus depreciation, which is really what makes this strategy so powerful. So you can make the losses non-passive, but to generate substantial losses, that's going to be challenging to do without bonus depreciation.
Okay, good.
Or actually losing money. So.
And then I think we can end it on this question here. Do you have any apps you recommend for logging or tracking time?
Yeah, so there's an app called RepsLog. I've recently reviewed their tool, and it works pretty well. So RepsLog, you can do it. You can use it for reps or short-term rentals. You can use a spreadsheet like Google Sheets or Excel on a mobile device. Or there's another time tracking app called Toggl, Toggl, which I personally used to track time a few years ago, and it was also a pretty good time tracking tool. So those are just a few options. There's other ones out there.
Awesome. And I'm putting the links to both of these in the chat for anyone who wants to check them out. Awesome. Well, thanks so much, Thomas. We got through so many questions, so it's great to see people getting their questions answered. And yeah, I think there's lots of good information here for people. So yeah, thank you for joining us, and thank you for everyone who called in.
Thank you for having me.
All right. Have a good rest of your day, everyone.
All right. Bye now.